It's been a steady quarter for DCB Bank as well. We've got Mr. Murali Natrajan, the Managing Director and CEO, joining in live to talk a little bit more about the outlook on the bank. Let's begin by discussing your net interest margins as well. In terms of the fact that we've seen a surge in the cost of funds, your margins still continue to expand. So what's the outlook for FY24 there?
So our business model is operating on a margin of somewhere between 370 to 375 basis point. We have two types of books in our advances. One is linked to MCLR, where as and when cost of funds change, we can change the MCLR. However, we pass it on to customer on a quarterly basis. With respect to EBLR, it is linked to policy rates of Reserve Bank of India. So as and when that changes is when we make the change in EBLR. Now, what has happened is there has been some changes in the EBLR in the past few months. However, the cost of funds is still to catch up because deposit rates have moved up, although it seems to be stable at this point in time, the deposit rates. So I expect that our margins from a business model point of view will still operate around 370, 375 basis point. Of course, our intention is to continue to expand margin, but I think this 4.18 that we have right now may not be a sustainable kind of margin. Having said that, margin also depends upon the mix of products. As you know, we are a very retail SME focused business. We have only about 8 to 10% in corporate. Also, as we continue to put our emphasis on CASA, I believe that also should help us to sustain the margins. But 4.18 looks like a slightly higher margin than what our business model seems to indicate.
There is a fight for liabilities. Everybody wants to get that next deposit check from the depositor. How does a mid-tier bank like DCB make sure that the next liability check comes to you? Because every bank is offering a better rate. Every bank is offering an internet solution. Every bank is offering you benefits of taxation. So what are you doing to ensure that you do not lose when there is a war of liability?
That's a good question. We have to constantly innovate our deposit products. We have to constantly innovate our deposit products. For example, we have changed the interest rates in savings account to make it attractive for smaller deposit customers. We are planning to introduce a couple of more nuances in our savings product so that customers find it attractive. We have to constantly do marketing and micro marketing, and we have to make sure that the branch scorecard is stacked in such a way that the frontline team focuses on deposits. It's not easy, but we have been very successful so far, and we believe that we'll be continuing to be successful.
When interest rates they start peaking upwards, they will, whether it is this quarter or next quarter, do you see a situation where things on the credit front will also start normalizing? Because higher interest rate historically have been an indication of credit growth as well.
So, I'm not sure exactly what you are looking for, but looking at the interest rate situation now, now that there is a pause in, at least for the time being, in the policy rates, I believe that the interest rates will remain stable at this level. We see in the segments that we are targeting strong demand for loans still. And our confidence in terms of doubling the balance sheet every 3.5 years at the current rate of growth remains intact at the moment. And as far as credit cost is concerned, one of the biggest challenges that we have dealt with is the COVID-19 pandemic. As you know, we target SME, MSME segment, which got most impacted by the pandemic. Yet, we didn't get into any loss situation. We didn't have to raise capital. Our capital position is still strong, and we have bounced back very strongly. In fact, our credit cost indicates that we have bounced back strongly. Yes, market also has done well. We believe that our business model operates around 40 to 50 basis point type of credit costs, and we are confident of maintaining even at the current interest rate.
How do you exactly see the retail stroke the SME book moving? Because those are the two differentiating factors for DCB. You are looking at a retail focus and a SME focus. You are lending to pockets where other banks are perhaps avoiding or they are not ready to take that risk. How do you see this strategy moving, and how do you think you will be able to price your loans?
So, I don't know about the other banks. We have been targeting this segment, SME, MSME, for the past now 14, 15 years. Right. That is point number one. Point number two, our average ticket size is about 30, 40 lakhs. Within SME, there are many sub-segments. We have decent analytics and credit capability, also backed by strong in-house collections capability. So we understand this segment very well. The demand in this segment at the kind of ambition that we have of doubling our balance sheet in between 3 to 3.5 years seems to be intact. We have also invested heavily in the frontline staff in the last 1.5 years. If you see our headcount, it has gone up by almost 27-30%. And the entire capacity of the headcount is still not realized. So we believe that the way the disbursal volumes are growing month on month, quarter on quarter, we still have runway to grow this balance sheet in the kind of numbers that I talked about. So we have reasonable confidence in growing the balance sheet at, say, doubling in 3 and 3.5 years, and there is enough market opportunity here.
At the current growth rate at the current credit growth rate, let me rephrase it, at what point in time you would be forced to come back, or you would be tempted to come back to the market to raise capital? Because beyond a point, you would be needing fresh capital to grow.
Yes. So our tier 1 is above 15%. Recently, we raised a tier 2 of about 300 crores. Now, the business model is such that we do secured lending. 80 to 85% of our book is secured lending. Our capital consumption risk weight is only 53-54%. So it's a very capital efficient model. Given the current growth rates, we don't see ourselves requiring capital for at least 12 to 15 months. Of course, if the market presents itself with an opportunity, we will consider. We have taken we are planning to go to AGM with an enabling resolution. But looking at the current trends, we believe that at least for 12 to 15 months, we may not require additional tier 1 capital.
Can I say that from your vantage standpoint, this credit cycle, what we've seen, is beyond a sugar rush? And for next 2 to 3 years, you think this kind of a credit growth rate will sustain?
Looking at the demand, looking at our frontline capacity, looking at what we achieved prior to COVID, looking at the numbers that are now stacking up, which are pretty similar to pre-COVID-19 levels, we have reasonable confidence that credit cost should hold at about 40-50 basis points, which is what it used to be prior to COVID in the same business model. And our growth rates should help us to double the balance sheet in 3 to 3.5 years.
The industry, and I'm using State Bank of India here as a benchmark, is talking about a 15 to 17% growth or 14 to 16% growth. And that's a large balance sheet. India's largest bank is talking about a 14 to 15% growth. So can I say that the multiplier, at least for DCB, would be 1.5x of that, bare minimum?
We don't look at it like that. We don't want to compare with such wonderful banks like State Bank of India. I would like to stay with DCB Bank. The business model is such that you need to be cautious because we are targeting SME, MSME. Compounding at 18-20% per annum profitably in a profitable manner is a good way to grow your business, and also you have to maintain proper liquidity parameters given the kind of competition that is there in deposit. So as we see momentum building, obviously we will aim for higher growth.
And final question, what about the fee-based component? Every bank has an ambition to really become big in terms of fee-based component. Banks have three, I'm just bringing this out for our viewers, just bear with me. Every bank had three basic revenue lines. One, transaction, which UPA in a sense has nullified that at that complete vertical. Second, fee-based income. And third is money which they make from lending. So you've spoken to us about the lending operations, where and how they're headed. Let's understand the second component, the fee-based component. In a competitive world where fintech is disrupting every component of fee-based income, whether it is insurance or brokerage or even for that matter wealth management, where do you see standing?
Our intention is to grow our fee income, and we are talking about core fee income. We are not talking about treasury income. We are not talking about PSLC, which can be up and down depending upon market conditions. The core fee income is growing strongly. If we grow our balance sheet by 18-20%, the momentum, the training, the branch scorecard, the products that we have seems to indicate that we should be able to match the fee income growth with our balance sheet growth. In the year-to-year comparison, if you look at the third-party fee distribution, the core fee income in terms of processing fee, the ATM fees that we get, the fees that are related to CASA, all have done very well. So we have reasonable confidence that our fee income should grow pretty much close to the balance sheet stroke advances growth.
All right, really appreciate your time. So glad that we got a chance to interact with you, and we must make it a habit not to wait for 2 quarters for our next interaction. Only we must meet more often.
Thank you.